Regulations and supervision of financial institution.
The Bangko Sentral ng Pilipinas, or the BSP, is in charge of making sure non-bank financial institutions, or the NBFIs, so like lending companies, pawn shops, and payment centers, are safe and reliable. It works to protect consumers. So the BSP ensures that this institution treat consumers fairly, like giving correct information and not charging hidden fees. And next is the mitigate risk. So the BSP prevents problems like fraud, tricking people, or money laundering. So hiding illegal monies by keeping a close watch on NBFIs. And the next is to promote financial inclusion. So the BSP helps more people access financial services, especially those who can't go to banks, while keeping the financial system stable and secure. And the next is, how does BSP supervise NBFIs? So licensing accreditation. So NBFIs need permission from the BSP before they can start their business. This ensures only qualified companies operate. And the next is the periodic reporting. So these institutions must regularly send reports to the BSP so their activities can be monitored and checked. And the third one is on-site examination. So the BSP, these institutions visits their offices, and the BSP visits their offices to make sure they are following the rules and operating properly. And the last one, enforcement actions. The NBFIs break the rules, the BSP can give penalties, suspend their operations, or take actions to fix the problem.
Hello, I'm Vanessa, and I'm discussing about the bank supervision's benefits. So it plays a critical role in ensuring the safety, stability, and soundness of financial institutions. The mandate of bank supervision is to safeguard and enforce depositors and ensure the financial system remains robust and trustworthy. Key objectives and examples. First is the safeguarding depositors' funds. Supervision ensures banks hold enough resources to meet withdrawal demands. For example, during the 2008 financial crisis, banks with inadequate oversight faced severe collapses. Second is enhancing public confidence. A stable banking system increases trust. Strict regulations like regular audits prevent risky behavior and ensures customers their money is safe. 3. Mitigating systematic risks. By monitoring bank practices, risks like credit bubble or lending excesses can be identified early. Fourth is preventing financial crimes. Supervision enforces anti-money laundering laws. For instance, regulators ensure banks comply with KYC or Know Your Customer protocols to curb fraud. And then we have the key benefits and examples. So, consumer protections. Bank supervision ensures customers are protected from fraud and mismanagement. For instance, if a bank engages in hidden fees or unauthorized transactions, regulators can step in, investigate, and penalize the bank. A notable example is when central banks issues refunds to affected customers after improper charges. 2. Systematic stability. Regular monitoring and supervision help prevent bank failures that could harm the entire economy. For example, after the 2008 global financial crisis, stricter regulations like the Basel III Accord were implemented to ensure banks maintain sufficient capital reserves to absorb shocks. 3. Regulatory compliance. Banks are required to follow legal guidelines such as anti-money laundering or the AML rules. For example, in cases where banks fail to report suspicious transactions, regulatory authorities impose fines, sanctions. SHBC, for instance, was fined losses in its AML process. Operational resilience. Supervisors ensure banks have contingency plans during economic shocks. For example, during the COVID-19 pandemic, central banks required financial institutions to stress test their operations to ensure continued their operations to ensure that the lending and services to businesses and individuals.
There are 4 bank supervision activities. First is supervision and monitoring. This involves a continuous collection and analysis of data from banks para ma-track nila ang health sa financial compliance with regulation and overall na performance. This allows for supervisors para ma-identify nila ang mga umaabot pa ng mga problems. Next is the risk assessment. Supervisors conduct through assessment to identify and evaluate ang mga risk nga ginatubang sa isa ka bangko. This includes credit card, market risk, operational risk, and other na mga potential na threat sa bangko, to the bank's stability and solvency. Next is the inspection. On-site inspections of banks are conducted para ma-verify nila ang accuracy sa mga information na gina-report para ma-assess ang internal controls and ma-ensure nila ang compliance with regulation and ang kaning best practices. This inspection can involve reviewing documents, interviewing the staff, and examining operational processes. And last is the enforcement action. If supervisors identify violations of regulation or significant risk, they can take enforcement action. This might include issuing some mga warnings, mag-impose ng mga fines, i-restrict ang mga activities sa bank, or even initiating sa mga legal proceedings. These four activities work together to ensure the safety and soundness of the banking system, protecting the mga depositors and for ma-maintain po lang ilang public confidence.
Purpose of supervision and regulations. The multi-phase of the supervision and regulation of financial sectors is to maintain the stability and integrity in consumers and promoting economic growth. There are 6 key objectives. First is maintaining financial stability. The 2008 financial crisis highlighted the importance of this. Regulations like stricter capital requirements for banks aims to prevent banks from taking on excessive risk and from becoming insolvent, thus preventing a domino effect on the entire financial system. Second, promoting consumers and investors. Consumers protection laws require clear disclosures of these fees and terms of financial products like loans and credit card. Third is promoting competition and efficiency. Antitrust laws prevent the monopolies in the financial sectors. Fourth is reducing systematic risk. Macroprudential regulations such as limits on mortgage lending or restrictions on the amount of leverage financial institutions can use aims to reduce this risk of widespread financial instability. Fifth, in enforcing compliance with the laws and regulations. Regulations, audits, and inspections of financial institutions ensure they comply with the regulations related to anti-money laundering. Know your customers' roles and data. Data privacy. 6 is maintaining public confidence. Transparency, accountability in the financial sectors are crucial for maintaining public trust. Ang pagdumala sa pag-regulate sa sectors financial importante kayo para sa masiguro sa mga sistema financial pahimong og lig-on pataas o pag-promote sa economic growth. Pinaagi sa atubang sa unom ka objectives regulations to create a financial environment that fosters trust, confidence, and prosperity.
Hello everyone, I am Sandra J. Tanilan, and today I will be explaining the International Monetary Fund or IMF role in central banking. So IMF is an international organization established to promote a global financial stability, encourage international trade, and reduce poverty worldwide. So the key roles of the IMF is first, surveillance, second, technical assistance, and third, lending. By fulfilling these rules, the IMF contributes significantly to a stable and prosperous global economy. Now let us move on to how IMF supports central banks and contributes to sound monetary policies. First, policy advice and technical assistance. The IMF conducts Article 4 consultations to evaluate economic conditions and provide policy advice for stability and growth, assist financial resilience through the Financial Sector Assessment Program or FSAP, and offers capacity building training in monetary policy, financial stability, and data analysis. Second, monitoring and surveillance. The IMF monitors global economic trends and risks through its global economic outlook and supports informed decision-making by analyzing central banks' operations and financial systems. Third, promoting international cooperation. The IMF ensures the stable exchange rates and payments systems within international monetary systems and provides a platform for central banks to exchange ideas and coordinate policies. And those are the rule of IMF and central banking.
IMF objective. So, International Monetary Fund is an international organization established in 1944 with the primary objective of fostering global monetary cooperation and ensuring the stability of the international financial system. Its key objective, as outlined in its Articles of Agreement, include promoting international monetary cooperations, include encouraging collaboration among member countries to maintain a stable and orderly system of exchange rates and financial flows. Next is facilitating balanced growth of international trade. So, supporting trade expansions to promote economic growth, increase employment, and improve living standards globally. Next is ensuring exchange rate stability. So, helping member countries maintain stable exchange rates, avoid competitive devaluations, and foster a predictable global monetary environment. So, next is providing resources to members. So, facing balance of payments issues, offering financial assistance to countries experiencing economic crisis, to stabilize their economies, restore growth, and prevent contagion effects. So next and the last one is reducing poverty worldwide. So supporting policies and programs that help low-income countries achieve sustainable economic growth and poverty reductions.